glad that somebody made money on that. But Caleb, I don't want you thinking you need to do that. Let it run out of steam. Let it run out of gas. It's not important. You're going to capture the trade that makes sense for you and your model. That's all you're trying to do. You're not trying to trade somebody else's model. You're not trying to keep up with somebody else's equity curve. You're not trying to impress dad with doing it faster than you think I think you should do it. I want you to do it at your own pace, slowly, not trying to keep up with the Joneses, not trying to make it heavier. It doesn't need to be heavier lifting than it needs to be, just based on what you have to learn. So don't complicate it. Let the price run. When you start seeing the market create a swing low, this is your swing low right here. What's that? That's a candlestick right there. Lowest candlestick that has a higher low to the right, higher low to the left. And then you, right at that point, at that candlestick's close there, that opening, that's when I'm going back through all of this to look for inefficiencies, to look for order blocks, to look for anything like a short-term high where buy side would rest. Well, there is none of that in this. It's just a one straight shot lower. So that also is characteristic of a Judas swing. It's something fake. They're going to run right back over top of that. If you look at the range that was created on this drop down to that low, where is this inefficiency at? In other words, the thing I haven't shaded here, the low, this candlestick's low to this candlestick's high. This one single candlestick right there. That is a fair value gap. It is a SIBI, a sell side imbalance, buy side inefficiency, but it's in the lower half of the price drop from the opening bell at 9:30 to create that swing low. And I seen that as soon as that candlestick closed and this one started trading. I said, okay, this one here is fake. And they rally it up into that. And they give you these little dojis and make you think, wow, it's going to drop. And I told you, nope, it's not going to drop. I'd rather see it trade higher. And once it trades higher, it can come back down in, but stay inside the upper half. We just saw a mohawk right there. That's all we saw there. It didn't go down to the lower half once it left it, which is that's the inefficiency model that I'm teaching you. That's how you know behind the scenes the algorithm is saying, all right, anybody that knows this information, quote unquote smart money, you're listening to them. They're going to expect that that's not going to trade lower. And then it starts to rally. Once it leaves this inefficiency, you have several things you can look for. A return back into the top of that inefficiency to treat that as a discount array. In other words, come down, hit it, and repel it higher. I'm going to take this off. Or what do we have in price? What's in this area right here? What do you see? See that big wick? See this inefficiency first. Let me get this real quick. With the volume imbalance. The tallest wick right there. Watch. This candlestick leaves this inefficiency the way we were looking for it to do it, higher, not lower. So it's failed because it's in the lower half. Now, if this inefficiency was all overlapping candlesticks, but then this one was there, then I would say if it got to here, then I would look for it to sell off a little bit. May not need to take out the low that formed there, but that would be one that could be tradable. And I'll show you examples of that today before we close. But here we have the consequent encroachment of this wick right there. So that means when this candlestick went up here and stopped, the next one we opened, it's reasonable to anticipate it to do what? Trade down to this candlestick's midpoint or consequent encroachment. To do what? To send price higher, because this is a discount array. And price goes higher. And then we get that fair value gap that we've been talking about all morning. What is this? We trade down into it, inversion fair value gap, sends it where? Lower. What color is it? Everybody knows what I'm teaching about inversion fair value gap is an orange hue. That means when it goes down through it, it's going to treat it as not as a buying opportunity. See, anybody else, if I would have had it like this, and I didn't say anything, you would have thought, oh, he's signaling that it's going to go higher. But what color did I hurry up make it? Orange. It's going to treat it as what? It's going to go down into this inefficiency, not to create a buy, but to fail. So this is why I'm telling you, I've seen so many people, and you got to let me get this off my chest because it's irritating, and it's doing a disservice to the community, and it makes my stuff look like it's not correct or precise because other people don't know what they're doing with these things, and they're trying to teach it. They're trying to sell it in courses. You can't do what I'm doing here. You have no idea what I'm doing. I'm teaching you so that way I can help my students. They are not your students. They're mine. They're paying you. I'm not getting anything from it, but the peace of mind knowing that you're going to parrot what I'm saying if you're doing it correctly. You're going to say everything I'm teaching correctly. And then my students are going to do well. And you're going to get the applause for it, and you're going to get the pay for it.